Hey there, everyone. Welcome to this special all-mailbag edition of the Final Bar. Happy Friday. Hope you made it through this week okay. We are going to be answering some of the great questions we've been receiving from all of you here recently, and we've had no shortage of questions. We appreciate so much you sharing what you're running into as you're trying to analyze these markets. And I will tell you, when markets get volatile, when markets get uncertain, this is where the technical toolkit is really designed to add value to your process. When everything is kind of just slowly going up or slowly going down, it's kind of a boring trend, and charts arguably aren't adding a whole lot because it's very clear. These are unclear times. This is a murky sort of period with a lot of question marks about leadership rotation, about bull and bear phases, about what sort of signs of deterioration we may be observing from breadth conditions and elsewhere. So make sure you keep sending us your questions. We'll do more mailbag episodes here going forward, and we would always love to answer one of your questions on our show. With that in mind, let's get to question number one. When you have a stock, Dave, that keeps making new highs, such as NVIDIA, how do you determine an upper resistance level? So here's the thing, right? We've actually had no shortage of stocks that have been going higher, SMCI, NVIDIA, and so many others that have had these parabolic rallies. And I would say with any sort of name like this, you know, there's sort of different phases to a trend, right? There's a breakout moment, right? A breakout phase, something that's sort of just early on, early innings of a move. And that would be like NVIDIA in January of 2023, when it's just getting out of this, what we call an inverted head and shoulders bottom. Maybe NVIDIA here in January, just breaking out of a base that had been in place for about 6 months, right? We hit resistance around 500, we finally break out. That's sort of an early breakout name. And when you do that, you can start thinking about the size of the basing pattern as an initial upside objective. And that would be, you know, comment number one, is when things are just emerging from a base. And a base would be sort of any sideways pattern, any pattern you can kind of draw a rectangle around and it captures most of the price action. That's what we call a basing pattern. And when you break out of that, that usually means something's different. So a common technique is to take the height of the pattern. So in this case, and I don't know if I would label this a particular pattern like a head and shoulders or anything. It's just sort of a complex pattern. So I'd probably just call it a general term of a basing pattern. What you would kind of do is take the height of that pattern. So back at the envelope, it's around 400 to 500, about a 100-point range. And so we would extend that from the breakout level, which means we break out above resistance. Our minimum upside objective is around 600. And you reach there, and then, of course, continued higher. So it is indeed a minimum upside objective. It's not an ultimate target. So what happens when things keep going? And when you reach that minimum upside objective, and clearly there's more optimism, we continue higher. So there are two general ways you can think about a market that keeps going up, right? You can either try to project the high, right? Use techniques like Elliott wave or Fibonacci extensions, as they call them, or Fibonacci projections. So we often talk about retracements, right, which is we're moving within a range, so we use Fibonacci retracements. You can also use those to project further levels. So do 138%, 161.8%, and sort of project further up there. Or, and that is something I can tell you about, but I'm not as much of a fan of option number two, which is just be a trend follower, right? If you listened to Jesse Felder's interview earlier this week, I thought he sort of gave a brief description of what it means to be a trend follower. Like when things are working, you want to be with that trend as long as it's working and look for signs that it's no longer working. And a number of my guests have sort of echoed that, which for me means you're looking at, you know, things like RSI for when they're overbought and come out of the overbought range. When you have bearish divergences, which NVIDIA did back here in summer of 2023. You look for indicators like PPO or MACD. They're actually trend following indicators that actually illustrate when an uptrend is no longer in play. Thinking of like the S&P 500, right? I think just using a simple trend line analysis and, you know, having a line that captures the general phase of the trend, and then you have a signal when that trend is no longer in play, right? So you can either project or anticipate the high, or you can confirm the high. And I think, you know, if you get too much into projecting a high, my problem is if you projected a high of 5,000 for the S&P, what if it keeps going to 6,000 or 7,000 or 10,000, right? So, you know, taking profits just because it hit a certain threshold is something that I learned from years working for growth money managers is just not a great option, because what you want to do is let your winners run. And if it keeps going up, you want to participate as long as possible. So it's much better to just have a trend following discipline. Use trailing stops, use trend lines, use signals that whatever was happening up until now is now changing. That's how I would think of charts like NVIDIA on high-flying names like SMCI. I'm immediately drawn to the RSI, the MACD indicators, looking for signs of distribution. That's what I would look for when you see things that are in clear and extended uptrends. Question number 2. Dave, do you see an ascending triangle pattern for $WTIC? That's the crude oil future, if you're not familiar with that. So, the two main crude oil benchmarks that you can track, the one is WTIC or $ WTIC on the StockCharts platform. That stands for WTI Cushing oil. So that's West Texas Intermediate. So that's sort of the main North American benchmark. If you have more of a European focus, you can use $ Brent, BRENT, which is Brent crude oil. Now, they're often very similar. Institutional investors, we would often look at both of those and think about what that means for U.S. versus European energy companies and supply chains and all of that sort of thing. But $ WTIC, if someone asks like, where's crude oil, this would be the series to look at for sure. And if you're looking for more short-term movements, by the way, USO is an ETF that tracks very closely the price of crude oil. So that's what I use day to day just to see what's happening intraday with crude oil. That's where I kind of look because I don't look at the futures markets too often. To your question, is this an ascending triangle? I guess my general answer would be, like an okay, yeah, maybe, yeah. It's not the most perfect one, and that's what I would say. It's not an ideal one, and the reason is because of this business right here, right? If you look, an ascending triangle pattern should be a very consistent resistance level, meaning a flat resistance level where we keep bumping up to it and we're not able to get above it, and then an ascending support level, right? So the lows keep getting higher, the highs are actually flat. If you look this high here, because it's well below that kind of neckline that you've drawn, and this was your chart that you shared with me, that's why it's not a perfect one. Having said that, I would probably not label it as an ascending triangle. I would label it as a basing pattern, which is my general catch-all term for we're in a consolidation, we're in a transition phase, and I have a clear level that would tell me that that transition phase is over, what I'd call a consolidation phase. So I think crude oil above 78 is a nice breakout. So I think whether you call this an ascending triangle or whether you think of it as more just a general basing pattern, a break above 78, really getting above these previous swing highs, would be pretty meaningful, and that's something that has been building for crude oil for the last 3 or 4 months or so. So ascending triangle, I think you have the general shape right. I would say it's in its ascending triangle-like pattern because this high not being right where it needs to be makes it less than an ideal pattern. I probably call it more of a basing pattern, but in either case, I would agree with your general implication that breaking above 78, 79 would be pretty bullish for crude oil. And if you think about that, think about energy stocks. This is your same chart. I mean, think about energy stocks that are now, no longer testing the lows, which they were in January. This is the XLE that we're looking at, but actually testing recent highs and actually very close to breaking out themselves. A lot of integrated names and E&P stocks, exploration and production names this week actually starting to break out quite a bit, actually a broad breakout in energy potentially. So I think that's a part of that story as well. Next question, Dave, you recently showed an unadjusted chart of BEN, that's Franklin Templeton, using _BEN. Why and when should we do that? Yeah, this honestly, this is a common question, and I don't mind coming back to it because it is an important distinction to remember. So, and this comes up a lot. And sorry, it's called Franklin Resources now, but same idea. When you're looking at a chart on StockCharts, and if you compare a chart on StockCharts to other platforms, what you have to remember is there is no industry standard that different charting providers all get together in a room and agree to how to do stuff. It's pretty much up to each provider to figure out how to do it. So StockCharts has worked with John Murphy and Greg Morris and Martin Pring and legendary technical analysts to sort of think about what should be the best practices that we're employing and have a good reason for doing it. That years ago, well before I was a part of the StockCharts story, led Chip Anderson, our founder, to adjust all of the price data. And what that means is when you're looking to the left on a chart of Franklin Resources and you look back a year or two ago, Franklin Resources actually did not trade at this particular price point at that particular point in time, right? At August 2022, the stock wasn't actually trading there at whatever it is, 26.50. If we put the underscore, that takes the adjustments out, and the actual price it was trading at was around $29 a share. So what's that difference? Well, here's the thing. Franklin Resources actually has a pretty decent dividend. They pay a dividend about 4.5% over the course of the year. That's your dividend yield. So basically, if you own Franklin Resources at the end of a 12-month period, assuming there's no big changes, you get about 4.5% of the value of the stock paid out in the form of a dividend that you get as dividend income. Now, what happens when a company reports or issues a dividend is the stock price is reduced by the amount of that dividend, so the price chart will actually have a little gap lower. The decision was made at StockCharts years ago that those gaps don't really represent investor sentiment or psychology. They just represent a structural change in the supply of a stock. So why don't we just get rid of those so that our indicators like RSI are actually driven purely on price behavior and investor behavior and not on artificial gaps in the stock. So what happens is every time the company reports a dividend, you adjust all the previous data, you adjust it up a little bit to meet the price. So instead of, you adjust it down a little bit. So the stock price gets dinged for the dividend, so the entire historical data series gets brought down a little bit to match the new stock price. And so further over time, the historical prices are less and less what was actually there. Now, why would you want to look at those? Well, if you're looking at support and resistance levels and really want to think about what the all-time high in Franklin Resources was or something like that, you just unadjust the data. So on our platform, you have a couple choices. You hit the underscore before the ticker, or below in our new charting engine, there's this little guy that says adjust for dividends, and that just does that quickly so you don't have to remember it. Either case, it's going to adjust the historical data, and we put it on the quote line right there, so you'll see it's unadjusted, and if it doesn't say that, then you're looking at the normal adjusted data series. You'll find some of our content contributors, people like Joe Rabel, Miss Schneider, when she comes on my show, always use the unadjusted data because that's the series they would look at. I tend to use the adjusted data unless it's something like a bank or a REIT or utility stock or a consumer staples name, something that pays a healthy dividend because it's really going to change the historical price data. For growthy stuff that doesn't pay a dividend, it makes no difference, right? Because there aren't any dividends really or big enough dividends to really adjust. So when I was talking about Franklin Resources, I probably put the underscore because that's what I usually do when I'm looking at a bank or a big dividend payer of some sort, just to make sure that I'm lining it up. And if you look at a longer term chart, like a weekly chart, it can make dramatically different results in the data series over time. So there's your answer. Next question. How would you compare and contrast two indicators, the RSI and the PPO? That is such an interesting question. I appreciate you asking about that. We'll bring up something like Apple just as an example. I have RSI here, and I'm going to switch this one to PPO. My general thought before I bring up the chart is to say these are two different types of indicators, right? RSI I think of as more of a leading indicator. MACD or PPO is more of a lagging indicator. And here's what I mean. You have two general ways of doing this technical analysis thing. This gets to the comments about NVIDIA earlier as well. You can either anticipate that a top is going to happen, or you can confirm that a top happened, right? You can either use a leading indicator or a lagging indicator. And look at Apple right here in August of 2022, and you'll see a perfect example of the relationship here. Apple becomes overbought here sort of the second week in August. You can see it continues higher about another 2 weeks before coming out of that overbought region. So RSI I think of as a leading indicator because the RSI becoming overbought is sort of that red flag telling you we've gone up a bunch, we're probably nearing the end of that upward move, and you want to look for signs of a rotation lower. And so waiting for that sort of exiting the overbought region often happens right about at the top or soon after. The MACD indicator, right, when this becomes overbought, you can see that the PPO or the MACD, and I use those interchangeably because they're very similar, kind of still bullish, right? It's just telling you that the trend is up because this is a trend following approach. This is trying to anticipate a trend reversal. This is just trying to confirm what the trend is. So it's not going to give the sell signal until after the price is actually rolled over, right? It's never going to tell you to sell here because at that moment, the trend is actually still quite positive. And if you look at the subsequent highs, you'll see the RSI becomes overbought usually first. It often will come out of that overbought region, sort of being that leading indicator telling you things are starting to slow down. And then the PPO confirms it in some cases weeks later because it's waiting for a rotation lower. So I think the big differences there are that they are looking at a leading approach, right, trying to anticipate the end of the move, and a lagging approach confirming the end of a move. Now, I would say that using these in conjunction, using them together, can be a very powerful approach. And you need to, think about what questions you're trying to answer, what timeframes you're operating on, but combining some leading indicators and some lagging indicators, combining things like support and resistance indicators like Fibonacci retracements, moving averages, Using all of those together is where we get to what I would call the mosaic that you're able to paint using a chart. I don't really, as much as I highlight a particular indicator and a particular signal, for me, it's a checklist, and it goes from Dow theory, moving averages, support and resistance, RSI, relative strength. All of these different things combine to give you a total picture of the technical conditions around a stock. Using a mix of different types of indicators can be very valuable. Great question there, and I hope that helps you understand the relationship between them. By the way, if you're learning an indicator like this, what I would do is, number one, go to our chart school pages, which are fantastic. It's a free resource at the top of our website, a bunch of great articles. When I was learning technical analysis a couple of years ago, I did use the StockCharts chart school liberally as I was trying to complement what I was learning from the CMT program and from clients that I was working with, and I found it to be super valuable. And it's been updated since then in a lot of ways, but I think the value is still very much there. The other thing to do is look at our scanning engine, actually look at stocks that are actually giving signals right now. Look at those charts and actually think about what it's telling you about the price conditions. I think that can be helpful as well. Before we continue on with the mailbag, just a couple quick announcements for you. Number one, we'd love to hear from you. This mailbag that we're sharing with you, these are literally all questions we've received from viewers like you over the last couple days. Keep them coming. We could always use some more questions, and the markets are always changing. There's always new information to consider, so let us know what you're running into as you're trying to use technical analysis day to day. Our email, that's the best way to get your questions to us, thefinalbar@stockcharts.com. On X, tag us in a comment at finalbarsctv. And here on YouTube, of course, just drop a comment below the video that you're watching. We would very much love to hear from you. We'll hope to answer your question in our next mailbag episode. Also, we have a survey going. We'll be running it through the remainder of this week. We really would appreciate your help in helping us sort of chart the course, pun intended, for StockCharts TV going forward. It's been a blast to grow our viewership and to grow what we're able to share with you over time. And we're thinking strategically about what's going to be next. You have an opportunity to share your voice and really influence the direction of StockCharts TV. So please scan the QR code that you see on the screen or click the link in the description below. Take a few moments and share some feedback with us. We would very much appreciate it. And then finally, just to let you know, I'm actually headed to Dubai over the weekend on Sunday. I'm going to be there speaking at the CMT Dubai event later next week. I'll be speaking with Julius de Kempener, founder of RG Research, frequent guest on the show. We'll be talking about different rotational elements here in early 2024, and I'll be moderating a couple panels with different market strategists from around the world. It's going to be a lot of fun, but I'm going to be focusing on that, but also we are planning to do a show every day. Because of the time zone difference, it's about 12 hours off of Seattle. Just give us some room. We'll probably publish a little bit later every day than we normally do, but we will plan to get a show to you every day, just checking in on the market, seeing how things closed in the US and what sort of takeaways you should keep in mind going forward. Let's keep going with today's mailbag episode with question number 5. Dave, can you describe the benefits of holding NVDA versus NVDY, the one that pays a dividend? So if you're not familiar, there's a series of ETFs that have popped up called these Yield Max ETFs. And I know like Tesla has one, NVIDIA, and probably Apple has one. I really have not looked into them a whole lot, and I don't use them. I've not traded in them actively at all, but I am familiar with them because they came up, and I want to make sure I'm on top of what's going on. Just to tell you, number one, I mean, in terms of what the difference is, look at the year-to-date returns between at the moment we're taking this between the two. In red is the stock NVIDIA, and this is from year-to-date. So starting at the end of last year, NVIDIA up about 35%. Here's NVDY, which is the ETF you're asking about. It's up about half that, right, around 17.5%. So what is the difference between these two? So NVIDIA, right, is a stock that, and I'll get the regular chart. NVIDIA is a stock that does not pay a dividend. Actually has a minuscule and might as well be a zero type of dividend. It's not a dividend payer, right? Big growth companies like NVIDIA rarely pay dividends. And the idea is, more established, more stable, long-term value-oriented companies think about paying back to shareholders in the form of a dividend. That's sort of an income component because it's sort of a slow and steady sort of earner. Think of a GE or a Coke or Walmart type of company, and you get why that's part of it. For a growth company that's still in a growth phase, and NVIDIA certainly seems to be that way in the last 12 to 18 months, they arguably are not paying a dividend because they're reinvesting all of that back into the company and investing it into further growth. So with a company like NVIDIA, you're really not getting a dividend component, but you're making a good money on your investment because of the capital appreciation, right? The capital growth. So the company, the value of the stock is appreciating so much, and that's where they're focusing their attention. Now, the problem is what happens when NVIDIA continues to go up and continues to go up, and what happens if you're concerned about that? Well, a common strategy, which I've talked to some of my option-related guests, is what's called a covered call strategy. That's where you own the stock, but you also use call options to sort of limit your upside, but give yourself an income component. So while it's not a dividend, it's actually creating a synthetic covered call structure. And by buying this ETF called NVDY, you're basically essentially buying NVIDIA with a covered call built into it. Now, what that actually means, and I would encourage you to read more about covered call strategies if what I'm describing doesn't make sense to you. It's basically a way to, usually on something that's been working quite a bit, you're concerned about further, the consistency of further upside, and you're certainly concerned about potential downside. So you use an option structure to limit how much upside you gain if NVIDIA actually goes up, but you benefit because you're protected more because you have an income component. So if the price goes down, you still get that income side of it. It's like a dividend payment on a stock. So the problem is when the company's still growing, and the stock price is still growing, the actual stock is going to far outpace the stock of NVIDIA. Or the covered call strategy. You're just limiting your upside on a stock that's actually going up quite a bit. So the short answer is, what are the benefits? The benefits of using a covered call or buying an ETF like NVDY is that you are, the benefit is you are cushioning yourself from downside in the stock. You have an income component on a stock that does not have a dividend. The downside is if the stock continues to go up, you're limiting your upside. You're not going to benefit from that. And I would argue if you really aren't comfortable with NVIDIA's upside, I would buy something else that actually is a decent dividend payer. I would probably get more defensive away from NVIDIA than holding something like NVDY. I don't see that as a great complement. However, they've gained quite a bit of flows. You can see the yield is pretty significant because it's paying out such a dividend. And actually, if you remember the answer I gave a couple questions ago about unadjusted versus adjusted data, this is the normal price series, which is an adjusted data stream, as we always use. I'm just going to look at the last year because it hasn't been around that much. But look what happens when we take the dividend, the healthy dividend out of that. This is what the price of NVDY has actually been doing, right? So it keeps dropping because it's paying out this huge dividend every month or every quarter, or whatever the structure is. And so as a result, the price really hasn't gone anywhere. The reason why the chart of NVIDIA is going up so much is because on a total return basis, you've made a good amount over time because of that dividend payment. It sort of supplemented that. So overall, I don't want to tell you whether it's a good option or not. That really is a specific question for you and how you're managing your portfolio, what type of portfolio you're running, and how you want to do it. I would certainly consult with a financial professional. Do your due diligence on something like NVDY or any of those yield max ETFs. Make your own decision as to whether you think it's a good fit for you. But that is what the ETF is designed to do. And again, unique in that they're creating an ETF wrapper to basically do a covered call strategy, which is widely used already in the industry. Next question. Dave, when drawing Fibonacci retracements, should the levels be based on a log scale? Now that's an awesome question. We'll look at Apple again, just as a brief example here. So when I apply Fibonacci retracements, and I do it on the show occasionally, but not all the time, and it's usually more just because of time. It takes a little bit of time to put these levels on. So if I don't do it ahead of time, it's hard to take time and make sure I'm drawing the right levels. But here's a basic Fibonacci analysis of Apple off of the January 23 low. You can see the July 23 high, 38.2% of the way down is around 169. It ended up being a pretty good place to accumulate more Apple to ride a retest of the previous highs. And I would say if support does not hold here around 180, that would be my next downside objective, would sort of be in this range of that first Fibonacci support level and the recent lows in September and October. But if you look at the Fibonacci relationships, right, 38.2% of the way down is this much. 38.2% of the way up is a much bigger space, and that's because I'm using a log scale. And so to answer your question, yeah, I think you want to use the values, right? So when I say 38.2%, These Fibonacci retracements were first applied when log scale was a lot less common. Everything was on an equal arithmetic scale, which means a dollar has the same value on the vertical axis the whole time, which meant the Fibonacci retracements look pretty evenly spaced, right? So from the top and from the bottom, these kind of look like they are equally distributed. Because I'm using a log scale, the Fibonacci levels are going to be exaggerated up to the top because of the run higher. And if you want to see a more exaggerated version, that's not the ticker for Tesla. There it is. Look at like a Tesla. We'll look at like a weekly chart. So we're going back to this big run up. And if you look at the Fibonacci retracements, what happens is it looks like it's almost wrong because the 38.2% is way up here. And then look at this huge space. But that's the reality, because this was a huge dollar gain. But compared to where it ended up at 420, 38.2% of the way up off the low is $165, up from $12, because the high is up here around 415. So this is an accurate representation. What you're asking is, should I use equally distributed Fibonacci levels based on the vertical, like actually the visual representation of the data? I would argue absolutely not. I don't think that's very justifiable given what Fibonacci retracements are actually trying to identify, which is, something had a move, and what's the move on the way back? It's 38.2%. It's that value difference that's really the key to it. So I think the proper way to adapt Fibonacci retracements is to adjust them using the same scale that you adjust the chart. So if you have log scale, we scale ours automatically, and that's how StockCharts is built in. You really don't have much of a choice beyond that. I would argue doing it a different way is not particularly accurate, given what Fibonacci retracements are really trying to accomplish. I hope that answers your question. Next question, number 7. I know StockCharts can plot the Hindenburg Omen for the New York Stock Exchange with exclamation point BINYHOD. Can I plot the Hindenburg Omen for the NASDAQ? Really interesting question, and it's funny. We had Jesse Felder on this week talk about the Titanic syndrome, which is probably a similar idea of an indicator with an equally foreboding name, and that was looking at market in an uptrend, but a bunch of new lows come out, which I get the argument of it. The Hindenburg Omen a little different. I'll bring up my Hindenburg Omen chart to show you. We've talked about this recently, and I put a YouTube video on my YouTube channel called Market Misbehavior recently, where we mentioned, went through the mechanics in particular about what the Hindenburg Omen is actually trying to do. But this is the index that you mentioned, which is the Hindenburg Omen using the New York Stock Exchange data. Now, what you have to remember is this indicator was designed years ago, and I think it was in the mid-90s or late 90s when it was originally created by this guy named Jim Mieka, and he used the New York Stock Exchange Composite Index and used breadth data on the NYSE Composite Index to create that indicator. Now, since then, there have been adaptations of the Hindenburg Omen for the NASDAQ, the Hindenburg Omen for other things, and all you need to do is at the top here, type Hindenburg, and you will find the 3 tickers. So here's the one for the New York Stock Exchange, there's the one for the NASDAQ, here's the one for the TSE, the Toronto Stock Exchange. Now, to be honest with you, I would argue that Jim's original work was based on the New York Stock Exchange. I really don't pay attention to other versions of that. A number of people wrote in when we mentioned the Hindenburg Omen and said, well, it's already signaled for the NASDAQ. I see that as sort of a weird adaptation of an indicator, and breadth on the NASDAQ is pretty, I don't want to say it's pretty dumb, but it's pretty weak. And the reason is because the stuff in the NASDAQ that's not very good is really junky. And so the New York Stock Exchange is more of a quality group of stocks, for lack of a better term. It's kind of looking at small cap breadth. Small cap breadth is always really weak because small cap stocks, many of them don't survive, right? They're just not good companies, and they never really get out of that small cap space. So breadth on something like the NASDAQ, I've always avoided. We did a bunch of studies in my Fidelity days to sort of validate statistically why it wasn't super helpful. So that's my argument for I would just stick with the regular Hindenburg Omen using the New York Composite Index and the data below there. Now, we also got questions about, can we compare it to the S&P because it's using the New York Composite Index? And I would argue, yeah. If you look at the performance of the S&P 500 and the performance of $NYA, which is the New York Composite Index, I mean, they're different, but I mean, are they that different that it's like a completely different world? Like, I don't think so. I think they're very similar representative measures of broad conditions for the equity markets in the U.S. I don't have a big problem with that. With thinking of the S&P as the main U.S. benchmark and thinking of the Hindenburg Omen as measuring a good universe of stocks to think about breadth, I think that's sort of what Jim Mieka was getting at when you created that Hindenburg Omen. Sort of an interesting way that sort of next steps there. Could there be other Hindenburg Omen kind of things? Could you look at the Hindenburg Omen on different universes, different buckets like the S&P, the NASDAQ, and others, and make a combined sort of composite indicator as to where they all are? That's on my rainy day list, which is pretty long and does not get a lot of daylight, unfortunately, these days. Final question for the episode. Dave, looking at the entire I love the breadth of this question. Looking at the entire technical analysis toolbox, what single tool would you say matters most for someone who seeks to be a successful intermediate to long-term investor? I mean, there's so many ways to answer that, to be honest with you. And being asked to pick your favorite technical approach is like being asked to pick your favorite kid. I don't think you can do that because they're all unique. They all have their strengths and weaknesses. But I would say, I mean, to me, I would say an analysis of price, a pure analysis of price, right? And again, that comes from my mentors like Ralph Acampora saying, if you have nothing else, have a daily chart of the S&P 500. He made a career in a lot of ways of just focusing on the primary trend and making sure he was aware of when that was changing. And I think of things like trend lines and other ways of just assessing price conditions and recognizing when a trend has changed is probably the most important question you should be trying to answer as a technically oriented investor, particularly a medium and long-term investor. Your goal should be figure out what's working and lean into that, figure out what's not working and lean away from that, and just keep repeating that and have a process, a routine to help you rotate out of what's no longer working and rotate into what's starting to work. I would think that's something to think about right about now as you have leadership growth names in the S&P and the NASDAQ starting to pull back. You have beaten down areas of the market like energy starting to improve. Is this that sort of leadership rotation? I think if you analyze price, you won't miss a big change, right? And so I think, and then the other, I guess, way to answer that is I think a lot of sort of novice investors just starting to use technical analysis get way too indicator focused way too early, right? So RSI is a very powerful indicator. I would never just use RSI and nothing else to manage anything. MACD is a really interesting indicator. It has some compelling signals that are good wake-up calls at times, but I would not, run a portfolio based on MACD. I would feel comfortable running money based on price conditions and recognizing changes in price and having tools that are very simple trend-following tools. I think that's better than anything. All the other things complement or validate what you're seeing in your analysis of price. So that's my answer, and I'd be curious what you guys think your answer would be. Drop a comment below. Let me know if you out of the entire technical toolkit, which one would you say matters the most? I'd love to know what you guys think, so drop a comment below and let me know. That's it for this mailbag episode. Again, thanks so much for all the great and thoughtful questions. Keep them coming. We'll do mailbag episodes continuing on here in the future. For StockCharts in Redmond, Washington, I'm Dave Keller. Have a fantastic weekend, and we'll see you next week. Bye now.